Yes, we can start.
A warm good morning to all. The theme which I have selected for today's presentation is the impact of option trading on the volatility of the underlying equity. So initially, I will just give you a basic structure on how options is and what is options, and then we will see what is the impact of option trading on the volatility of underlying. Because I chose this theme because the reason is that options or derivatives as a whole is considered as a speculative tool. So the question which arises is whether high speculations lead to volatility of the prices of the underlying equities. And the reason which came to this topic is that in 2019, the SEBI has actually prior to 2019 we had cash settlement of options or derivatives, but after 2019 SEBI came with a rule that all the options or the future derivatives should be physically settled. So why they came up with such a rule is that they came because they wanted uh, less volatility in the stock market. So there has been some studies considered in this area. So we will, after studying the basics of options, there are some couple of papers which has been done on that area. So coming to the first slide. So what is options? So options is not similar. We have already seen what is futures. So it is also options is also a contract or a financial tool that is linked to an underlying asset. That an underlying asset may be a stock, it can be a commodity, it can be a currency, or it can be a bond or any other asset. So when you buy an option, you have the right to trade the underlying asset, but you are not obligated to. That is the major difference between an option and a future. In futures, you are obligated to buy it, but when coming to the options, you are not obligated. You have the right. That is, the buyer and seller does not have an option. The buyer has an option whether to buy or not to buy. So that is why we term it as options. So if you decide to buy, then we say that we are exercising the option. This is what options is. So basic terminologies which you need to understand before uh, studying options is that lot size, similar to the futures. Here in options also there is specific lots. On only on those lots we can trade. It may vary for each company. For we have seen in the futures, for example, for Manappuram it was 6,000, for Reliance it is 250. So based on the price of the price of the options, they fix the lot. So coming to spot price is nothing but the price of the underlying asset. So in this, since we are studying stock options, means not stock. When we say stock options, do not confuse with the term stock options with the employee stock option. That is completely a different term. When I'm saying stock option, it is when we have a stock, that is when we have a share as the underlying asset. So it is the price of the stock. Strike price is this price at which we are buying for it. For example, we also learn that coming in the option expiry is that each option has its own expiry, because in India we consider the last Thursday of every month as the option expiry. So we have trades, we have contracts for the maximum of 3 months. We have learned it in futures: near month, mid month, and far month. And a new terminology which comes into play, different from futures, is the option premium. In futures, when you buy a future, you need not pay an upfront amount. But when it comes to option, the peculiarity of options comes here, that we need to pay a premium, like an advance money. So that is why in the last session, sir has said that in futures we have the type of, that is unlimited profit as well as unlimited loss. But while coming to future options, we have a benefit of, we can limit our loss to the maximum option premium. Because option premium the buyer has to pay at what, if he is buying an option. But the maximum loss, if he buys or no, does not buy, the maximum loss which he have to bear is the option premium which he has paid. Coming to option settlement, I said we have different ways of settlement. We have physical settlement as well as cash settlement. But as far as India is concerned, after 2019, after the SEBI regulations has come up with that regard, we say that we have physically settlement of derivatives or options. And then we have the option buyer who buys the option, or who buys the right to buy the shares. We have option seller. Option seller, we also term them as option writer.
Yes,
The
Snehid.
types of options.
I think the
Yeah.
last part was not audible. Option writer. After that, you have said something. Right?
No, no, sir. I didn't mention anything there.
Okay, okay, fine, fine. So next slide.
Yes. So types of options, coming to types of vision, before explaining the types of vision, I would like to introduce you to the two, I would term it as styles of option, because prior to types, we can say it is styles. There are two types, styles of options, that is the European style and the American style. So European style options is the thing is that you can only, we have seen what is expiry date. The in European options, you have the right to only exercise that only on the expiry date. That is, for example, in India, we say that it's a Thursday. So you have only the option, we can only exercise those options on that exercise expiry date. But while coming to America option, you have an privilege that you can exercise that options at any time before the expiry date as well. So the thing is that American options is like loosely made, so that the thing is that you need to pay a high premium for that, for American option, because you are having a privilege in American option. So while you have a privilege, you have to pay high premium compared to European option. But as far as India is concerned, we do not currently, we it's in, when I read about options, we previously we had American options, but as of now we only have European options in India. That is why the term is that, for example, the Reliance, we after that, see, we see some CE, that is called European. The E is denotes European options. So types of options, we have two types, that is a call option and put option. So call option is nothing but when you are buying the right to purchase from the seller of the contract a lot of shares at a predetermined price, which is called a strike price upon expiry of the option contract. So you, in call option, you are buying the right to purchase the shares. So in a bullish sentiment, when you expect the prices to rise, you always go for a call option. So call option premium also goes up when the spot price goes up and goes down when the spot price goes down. So that I will show you the linearity, and for futures I've shown you that the price are proportionate, but here it is not proportionate, that I will show you in the trading. So coming to put option, in with regard to put option, you are actually buying the right to sell. In call option, you are buying the right to purchase, but in put option, you are buying the right to sell a lot of shares at a predetermined price. So you go for put option when you have a bearish sentiment and you expect the prices to go down. In those conditions, you go for put option. So here I have summarized what I, so we have learned what is short position and long position and all. So when in a long position, that is that you buy and then you sell in those positions. In bullish sentiments, you go for call options. And the same way for bearish, this is what I have said. For bearish, you go for a put option for in long position. But while coming to, you also have concept of short positioning. Short position is nothing but we try to sell the shares first and then we buy the shares. So we sell the shares at a higher price, and when the prices go down, we buy the shares. This is the concept of shorting. So when you have a bearish sentiments, you can go for shorting the call option. That is one option that is a term we have for call. At the same time, when you are bullish on the shares, you can go for a
Yeah,
shorting of
it's
put option.
rather than shorting, we can use the word selling, selling of call options.
Yes, sir. Selling of call. Yes, sir, perfect, sir.
Uh,
Calling selling of call
call
option when you
options.
have a, yes, when you have a bearish sentiment. The same way you can sell a put option at the time when you are bullish on that trade, because these are the, this I wanted to summarize it this way, because these are the ways in which you could trade. So the trading perspective I wanted to have this, because the markets may be bullish or bearish, but as we have already learned that there is no good time or bad time in the market. So we can trade at any circumstance, any position, any way, whether it is bullish or bearish. We have of various types of strategies which we can follow. That these are some of the strategies like we could follow while trading. So here I want to show you the how this thing is. For example, Muthoot Finance is a very common company among Keralites because it's a company based in Kerala. It's one of the leading NBFCs in India as well. So Muthoot Finance, they have options. So this is how options would be traded on an exchange. It will be termed as Muthoot. For example, for Muthoot Finance, it will be like Muthoot Fin August 840p. So cutting out, let's say Muthoot Finance, it is the underlying asset, which is a stock on which the options is being deriving its value. That is the underlying asset. We have the term PE. I've already turned why we term is P is for pull put and E is for European. That is how PE comes out. 840 is the strike price. So that there are various strike prices. It might be 840, 860 for various strike prices. They will be traded on the exchange. So that is not a problem. It is just that is a strike price. August is the expiry date. Expiry date because it is implied that it will be the last Thursday because in India we only have that as the expiry date. So it is implied that it is August is the expiry 20 last Thursday would be the expiry. So I would like to explain you diagrammatically how this thing works. So assume that I'm going for a 130. This is just imagination. Okay, this is an imagination numbers and all. This is not how it works. So for better understanding, I wanted to explain it in this way. So assume that I'm going for a call European option of 130 rupees. So here the currently, so only up to this part the chart will be available now. So this is the future. So after this part is the future part. So at currently the shares of and say that it is traded at 100. So yellow line shows the equity and the gray here shows the option premium. So at 100 I'm going to buy a call option. It's a CE. So I'm paying a premium of 5 rupees. So this over here on this end it is the expiry date. So that is assume that it is the last Thursday of August. So if the prices reaches 140, then I can buy the shares at 130 because I have bought the shares of strike price 130. I can buy the shares of 130 from that seller and sell it in the open market for 140. So that is the profit which I get. So 130 minus 140. So 140 is the spot price here. 140 minus strike price. The 130 is the strike price. So 10 rupees is the profit. But do I get the whole 10 rupees profit for me? So I don't get the whole 10 rupees because while buying the call option, I already paid a option premium of 5 rupees. So 5 rupees premium. So 10 rupees is the profit which I get here. So 10 rupees minus 5. So the final profit which I will be getting is 5 rupees. So this is when the prices has increased to 140. Let's say the prices stayed at 130. For example, in this position, it has not been gone to 140. It is staying at somewhere over here at 130. So in that position, will I get a profit? That is the question. So I have a strike price call option of 130, and the spot price at the expiry is also 130. So there is no difference in the spot price and the strike price. So that there is a zero. So some may say that is a break even, but it is not a break even because I have already paid 5 rupees option premium. So that is the loss which I am going to incur, 5 rupees option premium which I have paid. So that is why sir has already told that in options we have limited loss. So if 5 rupees is the maximum loss which I have to bear. But in this, when it reaches 130, I would not excise the option because it is a loss for me. So I will not excise the options because I will just pay the 5 rupees. I will bear the loss of 5 rupees and I'll go with it. So there are options. So 140, if it is if the strike price is less than the spot price, that is the spot price 140 is higher than the 130. So if the spot price is higher than the in the strike price, in these conditions we say that it is in the money. That is, we have a profit in that those conditions. But if it is a
The people, I mean, students can also need to understand that the premium amount is growing when the stock price is also
yes,
growing. That premium amount, rupees 5, at rupees 5 in which Sneh has bought the option. And after that, when the but it is 6 right now, then 7, 8, 9. This is premium, right? The bottom level.
yes sir, premium.
Okay. So when the spot price reached 140, the premium is also increased. if Snehit wanted to sell the that option, he will get the premium of 10 rupees 10. Okay.
Yes, sir. That is
Uh,
how it is. That is how we relate it actually.
yeah. So,
So 10 rupees is a
but in the money means Snehit, we need to get something out of this because he had bought option at a strike price of 130 rupees. So, and he spent 5 rupees as premium. So the price is 130 if he executed the option. Not possible to execute the option. 130 means because we are following the European style of option, we cannot execute the option till the expiry date. So we have to wait till the expiry date. So 130 means 5 rupees loss. 140 means he can be able to get 5 rupees profit because the difference between 140 and 130 is equal because 130 is the strike price, the 10 rupees. So 10 rupees minus 5 rupees premium already paid. So the 5 rupees 5 is the profit. So rupees 5 multiplied by the number of shares in the lot. I already pointed out that there is a different load size following the different stocks. I think it is determined by the exchange. So, what is the, we have to check what is the number of shares. If the number of shares is 1000, Snehit will get 1000 into 5. That is 5000 rupees is the Snehit earnings out of this. Okay, continue Snehit.
yes, sir. So that is how for as far as call option the things work for. But now coming to the put option, I will explain it similarly with put option with this with a diagram so that you can understand better. I think so. Here for 120 is the spot price of the shares right now. So I'm going to buy a put European of 110. So when it comes to web, we have already seen that you go for put option when you have a bearish sentiment. So in that case, he's expecting the price to fall. So at the expiry, the price of the equity is 100 rupees, and he has a right to sell at 110. So in this case, he will buy from the open market. He will buy the shares at 100 rupees, and he will sell the shares at 110. So again, that is the profit which he gets. So 10 rupees profit here because 110 minus 100. So 10 rupees profit minus the premium which he has paid minus 5 rupees. So again, his final profit would be 5. So thing which you need to understand is as below as the price, this 100 goes, that is his profit. If the price has reached 80 rupees, assume that the price has reached 80 rupees, then the profit which he is going to get is 30 rupees. That is 110 minus 80, 30 rupees. And that is not the final profit. From 30, you have to reduce the premium. So 25 is the final profit which you are going to set. So in put option, as much as the price grows down in the at the expiry date, that is the profit which he is going to get. Am I right, sir?
Yeah, right, exactly, exactly.
So that in that position, you would say that you are in the money. But there is also another scenario, right? So if, for example, if at the expiry date the price is at
Snake, one thing we have to stick because somebody may be confused because we are now explaining the call option buy and the put option buy. So the call
yes
buy
sir
and put option buy. The last slide we have explained the call option buy and here the put option buy. Okay.
yes sir.
So next,
Because I
yeah,
thought that better to understand because rather than going for
yeah.
just saying this
That.
part.
This is a way it is nice. You know, when we explain the call option buy and call option sell same time, may be confused. Okay.
Yeah, that's why I thought I will in today's slide I include only the buy part of call and put.
Yeah. Right. Okay.
So
Okay.
that because if you understand buy, I think after a bit thinking you can get an idea on sell as well.
Yes.
So here, if there is another scenario which could happen is that at the expiry that spot price would be at 110. So that in that case he is not going to exercise his option because he has to buy the shares at the open market as 110 and he has again to sell at 110. So in that case he will not exercise his option. So and that scenario as we refer to is at the money, and in that case again he has to only bear the loss of the premium amount which he has already paid 5 rupees. So I hope with this diagram you got an insight on how this how the traders see to options by. So again some terms which these are some terms which we have already seen, but there are some technical terms referred to it. That is, one of them is the intrinsic value upon expiry. Intrinsic value upon expiry is nothing but the spot price minus strike price. In this case, for example, in call we have seen this, the spot price is 140. 140 minus the strike price. Strike price is the CE 130. So that 10 rupees here, spot price minus strike price, that 10 rupees is the intrinsic value upon expiry. Why I have written like this is that there are some times it might go to minus, right? We have seen that scenario also. But for intrinsic value upon expiry, we will never term it as in minus. Even if it is in minus, we will say that is 0. We will not term it as -5 or -10 or something. It is 0. So intrinsic value upon expiry, if it is out the money, means we say it is 0. So coming to the profit and loss that we have seen. So intrinsic value. So for example, in this case, the intrinsic value was 10. That is 140 minus 130. But the final profit I told that we will be getting only 5 because we have already paid a premium of 5. So 5 rupees. So that is the P&L which is referred here. So P&L is equal to intrinsic value minus premium paid. Coming to a break-even point. Break-even point is that where it is a no loss, no profit period, right? So in this case, so for example, in this example itself, we can say that the formula for a break-even point is strike price plus premium paid. In this case, the strike price is 130 and the premium which I am paying is 5 rupees. So 130 plus 5, 135. So 135 is the break-even point for me. So if the spot price at the expiry date is 135, that is the point which is a no loss, no profit point, price for me. So in this case, it is 135. I hope it's clear. So again, for put option also the same application is there, but slight changes in formula. That is because that terminology is different. So intrinsic value just it goes to opposite. For intrinsic value for call option, it was spot price minus strike price. For put option, it will be strike price minus spot price. But the P and L, it is the same formula. But break even also there is a slight formula because it will be strike price minus premium. Because in this case, let's see, strike price is 110, so premium is 5. So 105. So the max, if the spot price on the expiry is 105, that is the point which I will be having a no profit or a no loss price. So options pricing again, this is something, sir, which I'll also tell that. So how options are priced, there are actually various models because while coming to options, the valuation is a very important aspect. So basically, but I would say that when I refer to some papers and all, it was like the two basic things which affect the options pricing is the intrinsic value and time value. But intrinsic value valuation is a very complex area, and there are various models adopted in those area. Intrinsic value valuation. So intrinsic values an option's intrinsic value represents the profit potential of that option, and that is the based on the difference between the strike price. That is, we have seen that the strike price and the asset's current price, that is a spot price. So intrinsic value, but there are various models adopted in that. And the second important factor, first important factor is intrinsic value. Second important factor is time value. Time value is how much volatile the time value is used to measure how volatility may affect an underlying asset's prices up until the expiration date. That is, uh, all the options they have an underlying asset. So the volatility of the underlying assets affect the option pricing. So if the underlying itself is a very volatile one, it will have an impact in the option price as well. And so to sum up, I would say that the stock price, that is spot price, the strike price, and the expiration, these are the factors which affect the option pricing. And in that stock price, the spot price and strike price affects the intrinsic value, while the expiration date affect the time value. So these are the factors which affect the option pricing, but there are various models adopted in this regard. So coming to the key theme of the which I wanted to show you some interesting is who profits from trading options, because this is a question even which I had, and because whether is there a Robin Hood system in options, because options not only in options and derivatives has a whole, because the thing is that options we have seen that there is a lot and we need the margin is less, but we need a huge capital outlay because we are buying a huge lot, right? So we need a huge capital outlay. So I want, that is a question which arises, whether derivatives, is it a suitable format of trading, suitable form of instrument for a retail investor or an individual investor? So that is a question which I had. But in this regard, I have seen a paper. It was studied by who and all, and they found that retail investors, they for example, we have seen there are many various strategies, right? Option put, call buying, call selling, and all. Usually what happens is that 70% of the retail investors, they have a one-sided position, because they cannot concentrate on all the areas of the trading formats. They predominantly have 70% of the retail investors, they predominantly have hold one strategy. They hold on to one-sided positions in all, and in a single class of options. But while institutional investors, they will be having a very professional team of members who devotes their whole time in finding the results, finding the profits, finding the future trends and all. So what they does is they invest their money in this, in the various, they invest their money in various strategies. They will go for put, they will go for call, they will go for short call, they will go for long put. So they can invest the capital outlay. Institutional investors, they have the capital outlay as well as time to invest in different multiple strategies. So this particular study, they found that the retail investors using simple strategies are losing to the rest of the market. That is, actually, in institutional investors, they are making money out of retail investors. So this is what I fascinated me while going through that paper. Now again, coming to another aspect of options, which I want to speak.
Snehit, a little bit you can elaborate on this slide. Can you go to the
Yes,
previous
sir.
slide?
Yes, sir.
Previous slide.
Who profits from trading options,
Yeah,
sir?
yes. So here you explain that the individual means retail investors are with the one-sided option. That means they are purchasing
Yes, sir.
call option or purchasing put option. They're taking one position only. But
Yeah.
wholesale investors or institutional investors, they have some trading mechanism and they are using the multiple strategies. Like they purchase same call option and put option of the same stock, right? You are saying like that.
Yes, sir.
Okay.
Absolutely.
So they may get benefit out of this, and the who will suffer according to the positions of these institutional investors, or you're talking like that this option is not suitable for the retail investors, which is because we are fighting with the institutional investors so that who will because this is a game. I means one person will gain, another person will lose the
Yeah,
same
that
transaction.
exactly. That's
Yeah.
what. So the person actually losing is the retail investors, while institutional investors are making money out of the retail investors. The study shows like the results shows
Yeah,
like that.
exactly. That is a
So that
very
is an
big
interesting.
insight out of this.
Yeah, yeah.
Okay.
So next thing is that the key theme which I wanted to
And
put,
also,
the
we can
impact of.
point out that it is not like the retail investors losing all the time, but there are retail investors who are making profit out of this. We have to be
Yes, sir.
careful. We have to be careful while doing these options, because individual investors can also do this. Take two positions: call option, purchasing of call option and put option of the same stock, same time. That we can say that sometimes the put call parity and all. So this is a detailed technical concept which can be explained in the later. I mean, I think you will have a paper
Yes,
on financial
derivatives.
derivatives. Okay, that time you
Yes, sir.
will learn this put call parity and all. So this is very informative. These institutional investors are interested to purchase two-sided positions. They will purchase. They regularly purchase the put and call options of the same stock, so that they are not losing. Because if they are losing with the call option, and they will be benefited out of the put option. Okay. So there is a question
Yes,
arise,
sir.
who will be selling this option? The seller's position is, as per theoretically, the seller's position is weak. The seller's position, they are getting the limited amount of premium only. And their losses, if the position, if the trader sells an option, a call option, and the prices of the stock increases, and his losses may be unlimited. Not maybe losses is unlimited. So, who will trade the options? That is another question. You can find out. Okay, Snehal, continue. We can discuss this later, because if the sellers of options, sellers of options, they are getting the premium, limited premium amount only. But if their position, like if they sell call option and the share prices increases, and if they sell put option, share prices decreases, their losses would be unlimited. So
Yes, sir.
if there is a seller only, we can buy the option from the market. So who will be the sellers are interested to sell it or not? That is another question. Okay, okay, continue, Sneha.
Yes, sir. Again, the key theme which I wanted to focus is the impact of option trading on the prices of underlying. So, option trading, how volatile does it make the equity segment? So, there are some studies conducted in this regard, but I found some studies from the Chinese financial market as well as the Taiwanese financial market in this regard. So, this is where in the introduction part also I had said that while coming to settlement as well, India prior to 2019 we had a cash settlement, and after that we had the SEBI board of physical settlement to reduce this under the volatility in the equity segment. So let's see whether actually does it actually make whether does the options really impact the underlying equity. So here, based on some studies, I can support my findings. So the impact of options introduction on the underlying equities has been a topic of interest for decades, and there have been mixed conclusions coming out from this. But a study conducted by Hang Chen and all in the year 2020, a very recent paper, they has done various models in this, and they consistently uh, found that a significant decrease of the underlying equity volatility after the options introduction. So it is coming the opposite actually. What I thought was in 2019, what in Indian SEBI has brought that tool to reduce volatility, but this particular paper proves that that equity volatility decreases after the options introduction. So the main key area which they key reason why they support this the information flow. Yes, it is a very important thing which I even after thinking I found that information flow is a very important aspect for as well as options is concerned, because we for analysis we need a large amount of information. So I would say that this particular concept has evolved not only because of the improvement in the financial markets but also of the technology, because after the technological we have seen that we have abundant information available. We have like website like Screener which we get the complete details of the company, like credit ratings, annual reports, whatever it is, we get all their future announcements, we get all these information. So these informations, with these informations, the investors, whether it's the institutional investors or retail investors, they are able to do proper analysis, and this has significantly helped enhanced in the options. And so in this they Hein and Chandler proves that the decrease of that they found a significant decrease of volatility after the options introductions, especially because we have abundant of information flow on the underlying equity price due to these there are various factors like technological improvements and all. We have that information. So this is what their study happened, and their empirical findings based on Chinese financial market. This study based on Chinese financial market support the theory that options introduction attracts informed traders. Again, a very important term. They have again we since we have the better information flow among the investors, we can make a segment of informed traders and improves the information flow and liquidity of the underlying equities and consequently reduces their volatility. Again, to support this paper, and there in years back in 2018 2008, Cheng and Chang they did a study in the Taiwanese stock market, and they also it appears that the Taiwanese stock market also has become more efficient ever since the stock options were introduced. And the same reason they have also pointed out in their study that is because of the information being disseminated more rapidly due to the investors. The study found that unexpected, and again they have gone into a bit more than what the previous study. They found that unexpected options trading, that it's a key term, unexpected options trading, yes, it contributes to enhanced volatility, But whereas expected options trading, that does not lead to any volatility of the underlying equity returns. There is one more study in this regard. Another study indicated that the expected trading activity significantly affects the equity volatility in only a minority of firms. Again, this is also a study which supports the term that the options trading does not affect the volatility, means does not cause volatility on the underlying asset. This is a study conducted by Park and all in 1999, and very 20 years back paper. They also had pointed out the same thing, that expected options trading only significantly affects the, and only in minority of the firms. This is consistent with the contention that trading in equity options market does not systematically lead to price destabilization. Again, they are supporting that the trading in equity options market does not lead to a price stabilization in the underlying equity market. So that is the one. These are the papers which I have done. If I can share with you if you want the papers as well, so that you can go through it in detail. So that's it, sir. Thank you so much for hearing me, sir.
Okay, it was a very nice presentation, and we have got a lot of insights from the options trading and options market. It is very, options are very popular in Indian stock market. NSE is the biggest derivative exchange in the world, so that the majority trading comes out of the options and futures. Out of these options and futures, options are dominating right now. So as Snehit rightly pointed out, all institutional investors are interested to do options rather than the retail investors. But the retail investors are, in fact, less dealing with options. Any questions on this? You can ask Snehit. The presentation I can summarize like this. He explained the options and option terminology: strike price, spot price, options premium, etc., and expiration date, etc. And he explained the option, option payoff, that call option and put option payoff. When you buy call option, what would be your profit? What would be your in the money, at the money, out of the money? And put options, what would be your in the money, at the money, out of the money? So out of the money means we are in the lowest position, and in the money means we are in the money position. At the money means we are in no profit, no loss point. The break-even point is known as at the money. So all these things explained, and who are making profit out of the options were explained, and so all these things explained. So any questions you can ask